Welcome to the source of commercial real estate, where we talk to the experts in non residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I'm your host, Jonathan Hayek, and today I am talking with Malcolm Davies with Way Capital. Malcolm has over 25 years of experience as an award winning capital advisor and developer, having been involved with over $15 billion worth of total capitalizations. Both on the equity and debt side, he's utilized his expertise to lead developers and investors to structure and capitalize billions of dollars worth of commercial real estate ventures. He has extensive experience in structuring transactions across the capital stack, including non-recourse senior and stretch senior debt, mezzanine, and preferred equity financing. In the co-GP and LP side, if you want to know about the capital stack and financing, Malcolm is your guy, and we are talking to him today. Malcolm has a ton of honors, way too many to list here. He is a titan in the industry, and I'm thrilled to have this conversation with him today. He founded Way Capital in 2022, and in just that amount of time, the firm has been responsible for over $1.8 billion in financing across the U.S. So, Malcolm, thank you for joining me. How are you doing today?
Good. Thanks for having me, Jonathan.
Why don't we start out with you telling us about your background, how you got started in real estate, and what your work looks like today?
Sure. Let's see. It's interesting as you do this long enough, you start realizing that the history is a lot longer than you remember, and it went fast. Went to the college, went to the University of Arizona in the 1990s. Graduated, 25 years ago, which is unbelievable because it does feel like yesterday. Very happy with our sports programs right now, so we're all excited alumni. But I actually worked for the university in their economic development and real estate office while I was in college. And so I would say that was really formative for me to start my career. I was an analyst for what they used to call the Metropolitan Tucson Land Use Study. And I had a U of A car and went around all over the state of Arizona, met all the real estate developers, and really was what I would call would be like an analyst at CoStar today. That was kind of what I would do. But it gave me a great start and insight into commercial real estate. I met all these real estate developers, and I was just enthralled with the logistics it takes to actually get projects out of the ground. So I graduated from college and went for it. Spent a couple years kind of following my father's footsteps in the technology world, and realized that tech wasn't just my passion. And so transitioned back over to commercial real estate, and really, which is where my passion lies, and really putting deals together. As a real estate developer for almost 10 years, I had capitalized about $350 million of projects, really on the West Coast, Arizona, San Diego, Los Angeles, and Washington. We were doing mixed use projects, residential, student housing, and we did get into office, which we could talk about it a little bit today. But as I got into the office markets in 2006 and 7, it was a really poor decision. And so I learned a lot about what happens when the markets shift. And so in 2008, I was the young poster child, the real estate developer who was undercapitalized, was really facing lots of challenges. And, I actually went personally bankrupt. I had my company went bankrupt. It was very difficult, but it was one of those lessons in life where you learn so much, and you kind of figured out that era was one of the most important you could ever have in this business, which was, how do you restructure? How do you buy notes back? How do you get debtor in possession financing? How do you get all these things that you probably would never want to know about? I really learned how to do because of that era. So 2008, 9, 10, I did all that. And I think you and I have something in common in that, for me in 2009 and 10, how I paid the bills was flipping houses. But the reality was, I knew that capital raising was really my key strength. Just had a knack for raising money. And so the reality was, I knew I was broke. Coming out of a bankruptcy, had a very little money. And I said, how am I going to rebuild my career? I'm not financeable. I don't have any credit. And I made kind of a decision one day, which was, hey, I'm going to go help larger developers raise their capital and be able to help them come out of the GFC, because even the large players were dealing with many challenges back then, much similar as what we're starting to see today. But I was really fortunate in that, some of the first clients I really worked with were some titans of the industry, frankly. Individuals like Leonard Wood, Garth Erdesy, who's now runs Trammell Crow Residential on the West Coast. And I really learned a lot from those individuals. But I was so enamored with how to get deals done. I don't really give up. And so getting deals done where others may not have been able to figure out has been a knack for me. And so I think I remember in 2011, we were able to close, I think at the day was like $140 million of capitalizations on two ground up multifamily deals in the Inland Empire. And I remember when we closed them, everybody knew about it. And from since then, it's kind of been off to the races because, these were things that I could figure out because of my background. And that's why I called the firm Way. Way Capital stands for We Are You. And in reality, I truly take an approach that, when I'm looking at the opportunities to work with real estate developers and commercial owners, we really take the strategy of working together. We are a part of the team. We are your outsourced CFO team that is going to help you capitalize whatever it is that you think you need. And I have a lot of fun at it. I just enjoy it. And so if you're passionate about something, you can be successful. But again, the career is interesting because I went the opposite direction. Many people start in the capital advisory world and then get into being a developer. I will say that I'm, of course, I invest in a lot of opportunities, a lot of deals, but really have a passion for this advisory work. It's just a lot of fun for me.
Such an interesting story. And I think it's so interesting when I talk with someone with such experience that you have, and I hear about their story and their professional experience. Everything seems linear. And like I went this and this and this, but I know when you were in it, back in the GFC and you're flipping houses and trying
Yeah.
to get yourself out of bankruptcy, I'm sure it was hard to see your way out and see the future. But I want to go back to that. But first, I want to
Yeah.
kind of set the stage of Way Capital.
Sure.
Describe who Way Capital is, what kind of deals you do, asset
Sure.
types, markets, deal size, that kind of thing.
Sure. Well, I would, I'd start with, when we say we are you, represent commercial real estate developers and owners and helping capitalize their commercial real estate ventures. So that's a simple way of saying, hire us, we'll get the capital for your project. Everything from, we like to say co-GP. Well, what is co-GP? That's helping you get an early seed capital partner. Someone that will help you back a venture by bringing in their balance sheet if you don't have a balance sheet to do a deal of a size that is, obviously you need to have net worth and capacity. To your limited partners, we'll go out and source LP capital partners on your behalf through family offices and institutions. And then we'll go and negotiate financings for you and look at risk mitigation. One of the things that we really specialize in is risk. I don't think a lot of folks spend as much time as they should. Obviously, with my background, I can tell you risk is a big component of this business, and making sure you as a developer aren't taking any more additional risk than you need to through non-recourse financings and things that, I would really spend a lot of time with personally. I would say that one of the niches or unique attributes for us is we have a big expertise in mixed use developments, large scale, hospitality, residential, multifamily. These industries, I should say, have a lot of entrepreneurs. So if I said, where do we sit in the capital markets? We represent the entrepreneurial sponsor involved in institutional transactions. I think our average deal size is somewhere around 52 million, which, in reality, that's quite large. But, the large institutions sometimes are doing projects that are in 300, $400 million ranges. And we do as well. I just think that we kind of go up and down the capital stack, representing folks that are doing really cool, interesting stuff, from ground up multifamily deals where, you're trying to get, early seed development capital, meaning that I'm going to bring capital in to pay for construction drawings, to buy the land and all of that, all the way to the very end where we're closing your construction loan or putting in a long-term permanent loan to help you monetize your asset. So I think the one thing that I would say that people come to us on, because we're not part of the larger institutional capital markets organizations, being a boutique white glove service platform, we can take all of the fee, which we don't split with the mothership, to allow us to have more resources on your behalf. And I think I'm good at what we do. I'm pretty, but having talent and resources helping you really helps you in doing the what I like to call sophisticated transactions, which do take a heavier lift, but those are things that we can add a lot of value in. And at the end of the day, value is key. I like to say that if we don't provide 5 times the value of our fees, don't hire us. So we really, really stress that.
You all have a great website. It's really impressive. I really like the video. I also really like the deal examples and the
Sure,
portfolio section. Can you talk a little bit about some of the
sure.
really impressive deals that you've done? Because on your website, you've got these are not strip malls in suburbia. These are
No.
you've financed some of these really iconic downtown, really impressive buildings.
Yeah, we like to say that we really get excited about doing transformative projects. And so I love working on projects that become really trophy assets for places that people go to visit. And so you'll see that from our work, everything from the Ritz Carlton and residences in downtown Portland to the Pendry Hotel in downtown San Diego to the Asher Adams in downtown Salt Lake City. You'll find a common thread or a common theme, which is we are pioneering new elements of commercial real estate and markets that really haven't been done before. So, for example, if it's a residential project, generally speaking, the price per foot or the cost is higher than it's ever been before. And so you start to think about if there's no comps for something, you have to really be able to understand really the future and the momentum. And you've got to find the capital sources that can buy into that and believe in that. And I think that is a big component of the business. Everyone thinks that we really are in the finance industry, which we are, of course, but I'm in the emotional connectivity business. If you become emotionally connected to an opportunity, you believe in it, you will not necessarily just look at the numbers. You'll look at it and say, you know what? I get it. 5 to 10 years from now, I understand this. And so what are we looking for? We're looking for folks that understand these markets or these places that we do deals from a geographic perspective, from an asset perspective, and really a belief in that ultimate outcome. And I think our track record proves that we really do put these transformative projects together, and then when they deliver, these numbers hit, and all of a sudden people look back and go, wow, how did you do that? And I would always say that we're creating connections between our clients and those capital sources. And trust is like everything in this business. Everything else you can throw it out the door. If you don't have trust, you don't have anything. And so the deals that I've seen that don't go well have to do with breakdowns of trust. And so you get people together. Do they trust each other? It doesn't matter if it's a lender, an LP equity partner, mezzanine provider. Do they trust the sponsor or developer? Trust that capital source? Does the capital source trust the sponsor? And can they communicate? I always say this: if you get a call from somebody on your cell phone and it's not somebody that you want to answer that call and be able to talk to in any circumstance about anything, tough, easy, and you have a hesitation on that call, do not do the deal with that group. Do not do that. And it's not because there's bad people in there. No, it's just because they don't necessarily get along. They don't have the same disposition. And so that's something that we spend an awful lot of time on, is trying to make sure we curate a connection where people can really effectuate, business plans. I would say, why do we have a career, or why do I have a career? Because it's a lot of hard work to find the opportunities to deliver these transformative projects that really impact everyone's lives, but also to find that capital at the same time. I mean, the thought of having to do both is extremely time consuming. And so the reality of raising money, I always like to joke that I don't have to do the deals anymore. I'm not developing the deals. Let my clients do that. They're better at that than I was. At the end of the day, I'll go out and find the capital. Doing both of them is a hard thing to do. I always think that I have a lot of regard for folks that are out there doing deals, but using groups like us to help you raise money can help you focus on really what your best talents are, which is delivering the business plan of that development.
With the size of the deals that you're doing, you are not going to the community bank on the corner to source funding. So I want to ask you where.
Sometimes,
Okay.
sometimes. Yeah.
So besides the occasional community bank,
Mm-hmm.
where's your capital coming from? And then I have to ask if you can describe the sentiment of your capital
Yeah.
partners. We're in a tough. Here we are in December
Mm-hmm.
2023. We're in a tough lending environment. We're in a tough
Yes.
commercial real estate environment. So where's
Yes.
that capital come from, and what is if you could generalize the sentiment of your capital partners?
Well, let's go with the fun stuff first. Where does everything come from? And I'll talk about sentiment second. It's interesting. I think one of the really interesting things about commercial real estate over the last decade plus has been the growth of really the kind of the main street investors, right? Through crowdfunding sources or directly investing because a sponsor is good at raising capital through online initiatives or online elements. There's no better way than having a megaphone of social media to have people meet each other. And I think, I always say you got to trust your partners, but it's great to see them in action when, they're on, you can watch them via video. So I think that growth is really interesting for us because we see that growth continuing because having commercial real estate be another element of an alternative investment of your portfolio. It's just like having stocks and bonds, mutual funds, and the like. You want to have commercial real estate, I think, in your kind of bailiwick of investment. So in that sense, we're big fans of it. That being said, I would say that primarily where we're sourcing our capital from is from family offices, private equity, hedge funds, debt funds, foreign and domestic capital sources. I think the other growth that we've seen in the U.S. is no matter how we may think about things in America, we have really an amazing um, system of rules and laws, and we do. And I think we have an amazing element of land rights, and I think because of that, there's a lot of security for foreign capital to come into the U.S. and provide that through either direct into deals, but generally speaking, those are going to come through allocators, right? So those are going to be these private equity groups. They'll be through these hedge funds. They'll come in through separate accounts that are managed by those allocators that are great at making those investments because they have a great team of people. And those are what I like to call deal champions that represent these sources of capital. And deal champions are the people that I spend a lot of time with. I call it's called a deal champion strategy. And the reason why I call it a deal champion strategy is that there's always going to be an individual whose job it is to.
I lost your audio. There we go.
All
Okay.
right, I'm back. So I call it deal champion strategy. So what does a deal champion strategy mean? At all of these groups that we pitch deals to and spend time with, regardless if it's a family office, private equity fund, or hedge fund, or whatever it may be, there's this person whose job it is to find the opportunities and review them. It is our responsibility to make sure they understand the opportunity. And one of the things that I always like to say is that we represent not only our client in getting their projects done, but we also help represent that deal champion in understanding the opportunity. That deal champion at Carlisle or at Westbrook or at Balpost or whatever it may be, those deal champions really utilize us to understand the opportunity. And so our team funnels as much information back to those individuals that are reviewing the opportunities. And then they will walk down to the investment committee and pitch those deals on behalf of our clients. And I can't stress enough, if they don't have every piece of information that they're going to be asked in that investment committee, I don't care if it's a single source family office, single decision maker, whatever it may be, but you have to make sure you can answer all of the questions and be confident in those answers because you've done your diligence. Why would you put your career on the line for a deal if you don't have all of the answers? And I would say that that is one of the real unique aspects of our firm in that we make sure that those deal champions know everything, and we find that they end up, getting more of our deals through and approved because we are just, tenacious at giving them all that information and having focus, so that they can get all that information to the right, elements to make them confident. Now, how many times do we go to, how many sources do we go to on a deal? I would say that we can go out very wide. We have gone to 350 sources on a project. We have done, and on that project, we received one term sheet, right? But that became a very successful project. It's not the numbers of people that like your deal. It's the ones that understand it and can find that synergy or that elements like I mentioned earlier about, connection and understanding that they get it, what it's going to be like in 5 to 10 years. Because we all have to think forward. All of our decisions are thinking about going into the forward future. Again, I think you can hear hopefully how we think about it, but we don't call it a numbers game. It really is a connection game. And the individuals on the capital side have to also believe in us before, like I'm pitching someone saying, this is a very good person. We've done our due diligence. We wouldn't bring them to you if we didn't think so. And then we think it's a great yield for the investment. Whatever that may be, a debt, a loan or a mezzanine financing or an LP equity financing investment. So that's a little bit about the business, but the sources has never been wider. And I think even through dislocation, which is where I think the sentiment is, I think as we sit here in December of 2023, we've gone through obviously a shift in asset valuations. No question, right? I mean, even on multifamily, industrial, no matter what, is probably the best asset class today. That's down 10 to 15% simply because of interest rates. Multifamily is likely down 20 to 30%. Office is down 50 to 70%. And these are interest rates are core, capital, cap rates, capitalization rates, and interest rates. People have always said, how correlated are they? I think we know they're quite correlated. So the question really is, where do we go? I think in general, many people are waiting for what they like to call the capitulation. And capitulation is coming. Unfortunately, if you haven't stabilized your asset, your whole job over the next 12 to 24 months is to work your asset so that you can get either the tenant to come in, work the efficiencies on your expenses, and get your asset as stabilized as you possibly can so that you can get to a permanent finance facility either for yourself or for your buyer that would buy the asset from you. I can't stress there's never been a greater spread between floating rate or bridge debt or construction debt costs and permanent financing. We can see somewhere between 200, 300, 400, 500 basis points swing in cost of financing. In other words, if you were able to get a permanent loan on a multifamily asset today at 5.5% to 6.5% fixed, you're going to get bridge financing, construction financing that's going to be 9 to 10%. And you can see how costly that is for you. So to me, that my biggest recommendation is for folks that have assets today to work as hard as they can on the execution. And then also think about, what's in your portfolio. The institutions are certainly making decisions about not throwing good money after bad. They are definitely making decisions. Do they want to continue owning those commercial real estate assets? And I think you're going to see that continuation occur. And if you had too much leverage on your asset, I think you're going to see some of that capitulation occur in 2024. So that sentiment is a bit bearish per se. I think we've all can see that. But I think the next 12 to 24 months will be a massive opportunity for folks that do have dry powder, who can come in and acquire assets through discounted payoffs, through short sales, or even working restructures with current owners, which that's certainly things that we are working on today, which is helping folks retire expensive debt by utilizing preferred equity or mezzanine financing to help them keep and kind of live to fight another day. But again, that's challenging. It's difficult. It is part of our business today. But I would say that that's something, the sentiment is certainly there. Capitulation is the word I would use.
Malcolm, you've talked extensively about the idea of building trust and connections and relationships. That seems to be such a big part of your business. That's part of the purpose of this podcast, to widen my network and build
Sure.
relationships for myself. Can you give investors, capital raisers, advice, suggestions for working with high net worth individuals, whether it is private equity or family offices, people
Sure.
looking to raise capital right now? What suggestions do you have for them?
Well, number one, I think you need to be a captivating person, right? You need to be able to capture trust with individuals, and that's just a human connectivity element, right? I think no matter what, and if you aren't that type of a person, hopefully you have a partner that can help you with that. That's kind of step one. But really, step two, in my opinion, is your ability to communicate and being able to articulate the strength of an opportunity. What are the downsides of the opportunity, right? I think most investors, I think hopefully can ascertain risk. I think it's more challenging as it relates to syndications and maybe folks that don't understand commercial real estate as much. That being said, I think you really want to outline the pros and cons and what could or could not happen. But most importantly, I would say that from the capture of trust, the good business plan, thinking about where you have a synergy about, hey, I believe in that. That makes sense to me. The next step in that, and I think this is where I think I see a lot of folks that are syndicators that do falter in this regard, is a level of communication you have with your investors. Um, even when I was a sponsor, I think even the most challenging time periods, it was hard. I remember doing weekly phone calls with, where I had a lender taken over by the FDIC and they stopped funding a construction project, and doing weekly calls with your investors was hard. That was a deal that took 14 years to work out. Now we got it done amazingly, and it sold in early 22. It was one of those latent deals from back in 2008. But I would say that that level of communication is how you're going to retain your investors as well. Their feeling about how you care about them um, really resonates. It's not just the success and the opportunity. If you communicate it along the way and it's successful, that investor, of course, will come back. I'm positive with that, right? If you don't communicate and it is successful, they may or may not come back because it'll be that feeling that they have. Like they weren't sure what was going on. They don't know what is, maybe there's an uneasiness there. And then all of a sudden they got a surprise and it went really well. Well, that's great, but they didn't maybe have a great experience. And our whole lives are about experiences. And so investing is no different than that. So making sure that experience feels great for them. And then I think in general is having connectivity amongst your investor pool between each other. I think like-minded folks that are interested in doing things in different markets. I know, Jonathan. If you're in Colorado, for example, and you're a resident of Colorado, you probably understand the ski towns better than other people, maybe, or you might understand Denver better. Having connectivity amongst your investor pool, I think, is really critical. So investor events, things that create human connectivity, I think, are really important. And I just think, at the end of the day, what are we doing in all of that? That's all about continuing the establishment of trust. And then there's a care and a thoughtfulness around folks that are investing. I think, look at anything syndications or, look, I think I'm in 42 syndications today. I'm an investor. I really enjoy investing with sponsors that I like to do business with. But I look at it as an investor, just like I look at it from a capital advisor. And I do appreciate the updates. I don't know why, that's my personal feeling. And by the way, good, bad, or indifferent. I'm in office deals right now. Those deals are tough. Do I think I'm going to lose money on the office deals? Yes. Am I okay with that? Yes. I'm a big person. I understand that I can lose money. Um, I'm happy I'm an LP, right? I think in general, I don't have any more liability than the money I put into the opportunity. But I think, knowing the communication on even the tough deals is really helpful. And I think everyone's strong enough to know, hey, people can take good and bad information. Just don't sugarcoat it, right? Don't sweep it under the rug and then, bring it up later. That stuff is really critical. And that's my recommendation today, too. I think a lot of folks that are probably in deals don't necessarily maybe understand maybe somewhere that some of the risks that we might be looking at in the future. I can't stress enough, the biggest risk right now is ultimately getting out of any floating rate debt exposure. If you have it, the most important thing is being an investor in any deal is to think about that, and what is the strategy to get to that point, either to dispose of the property to somebody who can get permanent financing, or for yourself to get there. One strategy we are using in regards to kind of getting people out of the floating rate debt exposure is working with kind of what we call preferred equity or participating preferred equity. And that allows us to kind of get you locked into long-term permanent financing, but take a more friendly approach to a less costly approach than the floating rate debt to get you through. It doesn't work every time, but I would just say that that's an important dynamic. And I don't know. This one's meaningful to me because, I think in general the key to the whole business is what I just referenced, which is the human connectivity between that and the actual real estate. Of course, you got to execute the real estate. So if you're a tenant in a building you own and you're an operator, make sure they have a good experience, right? It's your customer. That being said, your investor is your customer as well. So you got to report to both of them.
Malcolm, I haven't been able to get through even half of the questions on my outline, and even as you talk, every time you talk, I write down 5 more questions. But as our time is wrapping up here, I guess the way I'd like to finish is taking some lessons from the GFC. You certainly had a tough time, but you came out better for it.
Yeah,
As of now, and you talked about developing some office properties in 2006 and 2007,
mm,
which didn't go well. So, I'd love to just kind of get your reflections on takeaways from those difficult times in '07, '08, '09, and how that's informing your business and how you're advising people today.
sure. Number one, humility. Really being humble. Um, I think the key to that humility is knowing that, you're no bigger or better than the greater financial markets, right? Understanding that, no one's perfect. People are going to make mistakes. Operators, investors, everybody. But having some humility about that, and then figuring out what you can or cannot do about that, I think is a really important dynamic as it relates to the next 2 year, 1 to 2 years. It's really, we live in a bridge world. If you're an operator, you have to have enough bravado and confidence and conviction to do a deal, right? That being said, that can also get to a point where that may give you too big of a, like I like to say, before me, I'm the first to say this. I was an arrogant asshole before 2007, 8, right? I was just like, oh, I thought it was really great. I was smacked a lot of humility in the GFC, and I'm so much better for it. I'm a better human, a better husband, a better father. All the things that I'm so thankful for that to happen in my life. Um, but that level of humility, I think, will help in the communication, the dialogue, the challenges that people are facing. And, like I think a lot of folks, at least, I've seen, you're starting to, see a lot of people, folks reach out to me and ask me questions. Hey, what do you think I should do here? How do you handle this? And, I'm having a hard time, I can't begin to stress, like, if you're having a hard time, talk about it with your friends, talk about it with your peers. We're all in this together as it relates to challenges in the market. But I can assure you, like, I wouldn't have made the recovery as a capital advisor if I didn't have recommendations from people coming out of the GFC that I was the guy that stood there, even when it was terrible. I'm not gonna lie, it was bad, but it was, hey, Malcolm stayed there and he worked his butt off. He tried his best. I think I made $6,000 from two. I remember this. It was from let's see, June. Let me put it this way: June of 2008 to June of 2011. I think I made $6,000. My wife fortunately worked at a bank, and she was supportive of me. That's another thing I would say. Have a supportive network around you. She kept my confidence up, but I certainly was hurting. So I don't know. I think in general, just really be candid about where this is going to be and what could happen, but also know that most people have made the same decisions. And, the ones that are doing maybe better than others are the ones that have been around for a long time. So if you're a young sponsor and you're faced some challenges, I think just being open about them, a lot of the older folks that are in the business will likely have a solution that you might not have thought of. And I think that's something that we could all do a better job at. I think in the industry is a lot more mentorship and a lot more discussions between generations because look, I'm 48. I've been through now two. This will be my second real cycle. But there are folks that I look up to that went through the cycles in the early 90s. And then particularly what I find interesting about how long it's been since our last cycle. I think someone gave me a stat that over 50% of market participants today haven't been through a cycle yet, just because it was so long between the GFC and now, which certainly puts me in the kind of range of the older statesmen, I suppose, because I'm getting up there. But it's I just think the communication is going to be key.
Malcolm, this has been a great conversation. Last question. If listeners want to connect with you, learn about Way Capital, where would you like to send people?
Just come to our, my website. It's waycapital.com, WAYCAPITAL.com. And you can call me or email me at mdavies, MDAVIES, at waycapital.com, and come see us and say hello in LA. And we'd love to chat with you.
Malcolm, it's been a great conversation. Part of the benefit for me having this podcast is I get to talk with people like you. I told you before we hit record that you're operating in a world that I am currently not playing in, maybe one day, but sincerely appreciate your generosity of time and expertise here today.
Thanks, Jonathan. Much appreciated.
Listeners, if you enjoyed this conversation, reach out to either one of us. We love talking about commercial real estate and we would love to connect with you. Thank you so much for listening. Until next time, take care.
Thanks, Jonathan.